Britain is still looking over the edge of a double-dip recession. One more quarter of contraction would confirm that, and the Bank of England is holding off raising interest rates to support that faltering recovery, while inflation has accelerated to its fastest pace in more than 2 years. Well, I'm delighted to say I'm now joined by a former member of the Monetary Policy Committee and Bloomberg contributing editor, David Blanchflower, about this and those downgrades of Greece and Portugal. He is in New Hampshire. Very nice to see you again. It seems that we're looking at It seems that we're looking at what's happening in Britain, and we've seen that the contraction is a little less than previously thought. Another quarter of contraction would confirm a double-dip recession. Firstly, how likely do you think that is? And secondly, how significant is it?
Well, I'm not sure that that's really the right way to think of it. I think we're really in the position of very low growth. I think there's some prospect that the first quarter might be a slight positive. There was some positive evidence from January, slowed after that. But I think Q2 and Q3 look more worrying. So when you add them together, it's very low growth or perhaps contraction over the longer run. So this is really worrying. And if you look at the data today, actually what was driving it was positive government spend and inventories. So all of this before austerity comes. So this is worrying, I think, going forward. The worry is, and if you look at Spain and Portugal and Greece and Ireland, the worry is, on my mind, cutting too deeply and too quickly. And that may well be the story across all of these countries, including the UK. Indeed.
I was talking to Danny Alexander on this programme yesterday, and he was saying that there really is no choice, that this idea of getting the deficit down within the term of this Parliament is what they need to do. They need to eliminate the deficit, and really that is their bottom line. There doesn't seem to be any desire to have a plan B.
Well, I think the evidence, I hear from my sources that actually the civil service actually has written a plan B. So a plan B, I understand a plan B actually exists. I think that's completely wrong what Danny Alexander said, and actually Nick Clegg contradicted it. This is a choice. The problem for politicians like Danny Alexander, who are not economists, is that they don't seem to understand that economies move in economic cycles, and they like to move in political cycles. What's so special about a parliament? The problem is, if you do these cuts and you compromise growth as it appears that they're doing, then they're in trouble. And if you deny that you have a plan B, then what? Are they going to just have to cut by more? What are they going to do? So it appears that they're not really ready to respond to events. And that should worry the markets.
Indeed. If we just can turn to Portugal, because it is such a big story today that we've just had these downgrades. Are we looking at a bailout for sure, in your view, or is there anything else that Portugal can do at this stage?
Well, I think, and we've talked on this programme for a number of occasions on this. I think that downgrades at the very least were inevitable. But I think you just asked a really good question a few minutes ago. How do you actually get a bailout when there's no government really to negotiate with? It sort of pushes you to, well, not an ordered exit, but a disorderly exit. And the worry is that it just pushes you to default because there's no other mechanism. If you think of what's happened, these countries have been left on their own and told to take this hit, take the fiscal austerity and do it quickly. And if you imagine that this is just too quick, it pushes them inevitably to default. What else can they do? And so, in a sense, it's because the package was inadequate at the beginning, it was first aid, and it pushes a crisis, makes a crisis almost inevitable. So I think, yes, it's making a crisis inevitable, and the markets seem to think that now.
And we've also had PIMCO today saying that the real battleground will be Spain. There are other people, of course, who are saying that, Spain is a different case. But then we heard that, when we were being told that Ireland was very different from Greece and that Portugal was very different from Ireland and Greece. And now we're hearing Spain's very different from all of those three. What's your opinion?
My view is actually that Spain looks very worrying. I mean, I've been looking at Portugal the last few days. If you look at Portugal, it actually didn't have a very big drop in output. It didn't have a really big drop in house prices, and its financial sector didn't really get hit terribly hard. So there you have Portugal really being in trouble. But then when we move to Spain, Spain built huge numbers of houses, lots of new houses with loans that, if you like, are now well underwater. And they had a big drop in house prices. So I suspect Spain really does look worrying, and the bank stress tests that are coming, I suspect, are going to say things more about the Cajas, the Spanish banks, and what happens if you really start to value these loans at market rather than at the prices that they were loaned out at. So I think Spain is really the big worry, and it's big.
Indeed. I mean, the concern is that if Spain were to require a bailout, it really would be a question, it would be a real test of the whole euro project. Do you see it in those terms? Is that too severe?
Yeah, Andrea, I do. I mean, I see it in the sense that the European Union and the ECB had a choice early up. When Greece and Ireland came, they really had to sort that out to prevent the dominoes tumbling. And they clearly have failed to do that. The government falls in Ireland, says we can't go along with this, we'd like to renegotiate the loan, and they say no, you can't renegotiate it, we're going to give you an over-indebted country, we're going to give you really expensive debt, and get on with it. So when that fails, what happens is you don't sort of solve the crisis, you cause more crisis. So I think the answer is probably at the beginning Spain wasn't in the crosshairs, but now, because of their failures over Greece and Ireland, and looks like today Portugal with the downgrades, and even as you've talked in your programme, Italian banks are now starting to be brought under. So I think it's a fundamental failure of the European area. They should have sorted this out some time ago, and now they're paying the price.
I just wanted to ask you one final question. What difference does it make that Angela Merkel had such a tough time in the polls at the weekend, and indeed she doesn't have an awful lot of backing for the euro bailout at home?
Well, I think the problem is that the public around the world, in a sense, doesn't really want this thing to be continuing the way that it is. You know, they want it all to be over. It's clear that actually Germany has benefited a lot from having a low exchange rate, being in with these other countries. And so the point is you solve this by the Germans paying for it, but of course the German public doesn't want to pay for it. So now we have classically what happens after a huge financial crisis. There's social unrest, there's all sorts of things that we worry about happening. So governments fall, big demonstrations as there were in the UK. If you got ahead of this thing early, that was what you could prevent. But now we're in governments weakening, political problems at home. I think we're in for a worrying year.
Okay, Danny, thank you very much indeed. It's a pleasure, as always, to talk to you.
Lovely
Thanks
to
for
talk
joining
to you.
us.